All right, so this is number 1, and this is for the chapter 1 homework on income tax accounting. It says Treasury Department Circular 230 provides guidance for doing which of the following activities? And the answer is number A, or letter A, I guess. Practicing before the IRS. Okay, that's number 1. Okay, make sure it's recording. All right, so which of the following is not a required conduct for a preparer of an income tax return under AICPA tax standards? And the answer is B, verify that the information the client provides is correct. Okay, so that's number 1 and 2. Okay, so here's number 3. It says choose from the drop-down list the probable justification for each of the following. Okay, so a tax credit is allowed for amounts spent to furnish care for minor children while the parent works. Well, if it's to support working families, then that's going to be a economic and social consideration. And that's what it is. Deductions for interest on home mortgages and property taxes on a personal residence. So the concept behind this is they want to encourage people to own houses. So that means it's going to be an economic and social consideration. Okay, fines and penalties are not deductible. So allowing deductions for fines and penalties would basically be rewarding bad behavior. So this is a social consideration. Okay. Net operating losses of a current year that can be carried forward to profitable years. So this is going to be considered an equity consideration. And the concept behind it is a business that loses money one year but profits another year should be treated fairly over time. So that's kind of like the idea behind it. A taxpayer who sells property on an installment basis can recognize gain on the sale over the period the payments are received. So that's a wherewithal to pay concept. And the rule is basically to ensure taxpayers pay only when they actually have cash in hand. Okay, so F. The exclusion from federal tax of certain interest income from state and political bonds. That is a political consideration. And your hint here is the municipal. So it lowers the borrowing costs in local and state government so that they can function better. That's the idea behind it. So G, prepaid income is taxed to the recipient in the year received and not in the year earned. That's a wherewithal to pay as well. Even if not yet earned, cash received increases your ability to pay. So that's the idea behind that. That's number 3 on chapter 1. Okay, so here's number 4 on the chapter 1 homework. It says, Mia owns a warehouse that has a cost basis of $80,000. The city condemns the warehouse to make room for a new fire station. It pays Mia $400,000 for the new property. It's agreed to fair market value. Shortly after the condemnation, Mia purchases another warehouse as a replacement. What is her recognized gain if the new property is $280,000? So, let's see. The government gives you $400,000. That's your new property. And that's what the government gives you for the land. And you purchase $280,000. That would equal 120,000. That is your recognized gain. That's for letter A. What is her recognized gain if the property cost is now 444,000? Okay, so we just do the same thing we just did. Well, it's going to equal negative 44,000. But we're just going to say 0. It's technically negative 4 in the negatives, but we're going to say it's 0 because it's a... that's the recognize. There is no gain, basically. That's what I'm trying to say. What is the recognized gain if the new property cost is 80,000? Okay, same thing. Yep, that's A, B, C, and what, if any, is the justification for deferring the recognition of gain on the involuntary conversion? The wherewithal to pay concept. And the taxpayer's position has not changed. So, hopefully my mic is on. I haven't checked. All right, here's number 5, and it says, how does the pay-as-you-go procedure apply to wage earners? And let's see. The answer is, the tax law requires employers to withhold a specified dollar amount from wages paid to the employee to cover income taxes. That's the answer verbatim. So, all right. How does the pay-as-you-go procedure apply to persons who have income from other sources besides wages? And the answer is, the tax law requires the taxpayer to make quarterly payments to the IRS for estimated taxes. That is number 5, I think. I think it's 5. It's either 5 or 6. Okay, here's 6, and it says, the Adams Independent School District wants to sell a parcel of unimproved land that it does not need. Its 3 best offers are as follows, and it gives us these 3 options. If you are the financial advisor for the school district, which offer would probably be preferable for a long-term financial standpoint? When we talk about ad valorem taxes, that has to do with property taxes. So, essentially, we're going to go with Baker Motors. And the reason why is the property tax is better than the other options. Even though the offer is slightly less here, the property tax is better than the other ones. It's easiest to explain. It explains it right here. I'll just read this for us. Property taxes on realty are used exclusively by states and their local political subdivisions such as cities, counties, and school districts. They represent a major source of revenue for local governments. And they get the most out of Baker Motors, basically. And that's number 6. All right, so here's number 6, and it says, Jake, a multimillionaire, has promised to give $25,000 each year to his 2 friends and then leave any remaining wealth to these friends when he dies. Jack believes that making the annual gifts will reduce his total transfer tax liability at death. Is he correct? Complete the following paragraphs below regarding Jake's gift to his friends. The annual transfers will Jake to use the annual gift tax exclusion to... anyway, let's just go ahead and do it. The first one is going to be avoid. Let's see. The annual tax is indexed for inflation, so transfers in subsequent years may benefit. Using the annual exclusion will reduce. Okay. Annual exclusion. Unified tax credit. Increasing. All right, that's the answer. All right, I believe this is number 7, and it says, as to those states that impose income tax, complete the following. Differentiate a piggyback approach in decoupling. For state income tax purposes, piggyback means using the federal taxable income as the state tax base. Make that bigger. And by decoupling, a state decides not to allow a particular federal provision for state income. And here's the rationale behind it. All the following states impose income tax on individuals, and here's some states. New Hampshire imposes an individual income tax only on interest and dividends. With few exceptions, all states require some form of withholding procedures. Okay. Use of IRS audits results as part of state tax audit. States often use IRS audit results to identify errors that might also exist on taxpayers' state tax return. Credit for taxes paid to other states. Most states allow their residents some form of tax credit for income taxes paid to other states. All right, I believe this is number 7, and it says, as to those states that impose income tax, complete the following. Differentiate a piggyback approach in decoupling. For state income tax purposes, piggyback means using the federal taxable income as the state tax base. Make that bigger. And by decoupling, a state decides not to allow a particular federal provision for state income. And here's the rationale behind it. All the following states impose income tax on individuals, and here's some states. New Hampshire imposes an individual income tax only on interest and dividends. With few exceptions, all states require some form of withholding procedures. Okay. Use of IRS audits results as part of state tax audit. States often use IRS audit results to identify errors that might also exist on taxpayers' state tax return. Credit for taxes paid to other states. Most states allow their residents some form of tax credit for income taxes paid to other states.